We're going to talk about is savings accounts and CDs. The second we're going to talk about is investment accounts, also called non-qualified investment accounts. Custodial accounts is the third thing we're going to talk about. Coverdell ESAs or education IRAs is the fourth thing we're going to talk about. And number 529 education plans. That's the fifth thing we're going to talk about. I'm going to give you the pros, I'm going to give you the cons, I'm going to give you the entire scoop, I'm going to give you my recommendations, and please take my recommendations and go do your own research, right? It's important. So the first way to save for college, it's actually one of the worst ways to save for college, but it's the way most people tend to do it. As you all know, savings accounts are fixed interest products. They give you what, 0.2%, 0.3%. They're offered by banks and credit unions. It's 100% liquid. You can always take it out whenever you need it. The funds are easily accessible. Look, online you could just do a rollover. You could swipe your debit card. It's easy to monitor right on your phone. It has FDIC insurance. That's a big deal. Up to $250,000 for you, $500,000 for you and your spouse if it's a joint account. Savings accounts have many benefits, but they have many drawbacks and many cons. You get very little interest. 0.04% sucks. I'm sorry. You can't live on that stuff. Look at this thing called inflation. Inflation is the cost of goods and services that you buy, just normal. Right now it's 1.25%. If you're making 0.4% and the things you're buying are growing at 1.25%, you're actually losing money and you don't even know it. Tuition costs, according to Business Insider, over the last 5 years, has grown an average of 8% every year. So if you're only making 0.4%, how are you ever going to catch up? Imagine that puny 0.4% they pay you. Now you got to pay taxes on that. What? It's not protected from creditors. You can get sued. It's used in calculating your financial need, which means when you fill out that FAFSA form, you got to put it in there. And it doesn't help you. It actually hurts you. Savings accounts, CDs actually give you a higher interest rate. You can get, according to the Wall Street Journal and Bankrate, you get as much as 0.47%. 0.4%, excuse me, that still sucks in my book. Especially when you lock it up for 5 years. You take it out, they penalize you. Why? I don't know, but they do penalize you. So we just talked about savings accounts and CDs. Now we're going to talk about non-qualified investment accounts. That Robinhood, TD Ameritrade, Schwab, Fidelity. You can go online and you can open up one of these accounts. The investment options with these accounts, almost unlimited. You can buy stocks, you can buy exchange traded funds, you can buy mutual funds, you can buy Google, if you like Apple, if you like Tesla, you can buy those in there. So your potential gains are higher. There is no tax benefit. That's one of the drawbacks to an investment account. A non-qualified investment account, you get to pay taxes on it every year. So if you have $10,000 and you happen to make, you had a good year. So you made 10%, you made $1,000. Your tax rate is 30%. Now you got to pay $300 in taxes. Why? That money should be growing for your child. It's also not protected from creditors. Unless you put your investment account in a trust, if you get sued, they can come after you for that money. Additionally, your non-qualified investment account is calculated as part of your FAFSA application, which means it hurts you. We just went over savings accounts, CDs, and also investment accounts. We went over the pros and the cons. Now let's talk about this thing called custodial accounts. That's number 3. You remember, I'm going to give you 5, and in my opinion, they're going from not so good to great. Custodial accounts are the third way for you to fund your college expenses. There's 2 ways to do that. One is called Uniform Transfer to Minors Act, UTMAs, UTMAs. The other one is called UGMAs, UGMAs, Uniform Gift to Minors Act. UTMAs and UGMAs are very similar. We like UTMAs the most because you get to do almost anything. You can do real estate, you can do stocks, you can do bonds. They're more flexible. So most of what I'm talking about today are UTMAs, Uniform Transfer to Minors Act, UTMAs. Here's the benefits of these accounts. There's no limit on how the funds are used. Remember, the kid is going to own this thing at 18 years old. So the funds can be used for, buying a house, down payment on a car, starting a business for the child, which is good. There's a wide degree of investment options, just like your non-qualified investment account I talked about. You can buy stocks, you can buy bonds, you can buy ETFs and mutual funds, you got cash. It's great. There are some tax advantages. The first $1,100 of gains in the account is tax-free. So if you have an account and you have $10,000 and you make 10% that year, that's $1,000, no taxes. But if you make 20%, guess what? Still no taxes. You know why? Because the next $1,100 is at the child's tax bracket. So I'll give you an example. Let's say you've been saving for a long time. Now you have $100,000 in this account, the custodial account. And that account had a great year. You made 10%. You made $10,000 in gains. The first $1,100 is tax-free. The remaining another $1,100 is taxed at the child's bracket. The balance of almost $7,800 is taxed at your tax bracket. Yikes! That hurts. Also, assets of these custodial accounts will be considered and expected to be used when it comes to financial aid. And now we're going to talk about the number 4 way to save for college, and it's getting better. These things called Coverdell ESAs. Some people call them education IRAs. They're a good way to save for college. Not the greatest way, but they're a good way to save for college. So let's talk about the benefits. Let's talk about the pros, and then we'll talk about the cons, and then we'll break it down for you. These accounts, these Coverdell ESAs, right? They have a great number of investment options also. Unlike savings accounts on CDs, you can do stocks, you can do bonds, you can do exchange traded funds, you can do mutual funds, you can do cash. So you get the opportunity to make more money. You can make a lot more money on these accounts. The investments also all grow tax-free. Hallelujah. Albert Einstein was once repeated to say, one of the 9 greatest wonders on earth is the power of compounding, especially when it compounds tax-free. When the funds are withdrawn, they're tax-free. I love tax-free. As long as they're used for qualified education expenses like tuition, mandatory fees, course-required textbooks, housing, college housing, and things like that. One very, very important benefit is you can actually also use it for K through 12. It's not just for college and trade school. You can use it for trade, you can use it for art school, you can use it for apprenticeships, right? But you can also use it for K through 12. Coverdell ESAs receive certain protections in the event of a bankruptcy. And depending on the state, some more protections may be offered. Here's the drawback to Coverdell ESAs. You are limited to just $2,000 in contributions per year, but that's not all. If multiple people are funding the same beneficiary, then they must be aware of how much each is contributing. For example, if the kid's grandparents are putting in $500, the parents only get to put in $1,500. So it's limited how much goes in. And especially with college as expensive as it is, $30,000, $40,000, $50,000 per year, it may not be enough to accumulate for college. If you file joint taxes with your spouse, your income has to be $220,000 or less. The funds must be withdrawn from the account by the time the beneficiary reaches 30 years old. Otherwise, you have to pay penalties and interest. So you have to deplete all this account. You can't hold it in there. Current tax law does not allow for funding after the beneficiary reaches 18 years old. You're not able to put in more money after 18, which could be a drawback because sometimes college takes 4 years. Sometimes they want to do a master's, they want to go to medical school. You can't put more money into those plans, right? So this eliminates the potential contributions during college and higher education. These accounts could also lose money. Remember, stocks and bonds. So please diversify. I'm going to keep harping on that. One of the most important things I can teach you, please diversify. This is also used in calculating your financial need, but only a small portion of it. Now let's talk about the 5th and final way that we recommend people consider when they want to fund education expenses. It's called the 529 Education Savings Plan. And this, by the way, in my opinion, is the absolute best way to fund college. Absolute best. You may have a combination of different ways, but this should be your mainstay, your main staple. 529 plans are similar to Coverdell ESAs, right? They're tax advantage investment accounts that could be used for college expenses. There's no income limit. So unlike the Coverdell ESA, that's limited to 110,000 per person. You can make 10 million and you're still allowed to put money to a 529 plan for yourself or your child. 529 plans are for wealthy people, middle income people, and not so wealthy people. Anyone can do these plans. They're really flexible. The account owner, here's one of the key benefits. Unlike the custodial account, the account owner maintains full control and ownership of the account, even if the beneficiary reaches the age of majority. If the funds are not needed for that beneficiary, so let's say your kid gets a scholarship or your kid gets a grant, you can just turn it for the next kid. You can use it for the next kid. You can use it for yourself if you want to go back to school. And you can actually use this for their child. One of the things I talk to a lot of my clients about is creating a multi-generational legacy fund for their family. You can create a fund for yourself, for your kids, their kids, kids, and so on and so forth to benefit your generations. A 529 plan is a great way to do it because if your kid gets a scholarship or a grant and doesn't use it, you can give it to their child. You can help your kids get educated. Education, as you and I know, is the key to financial freedom for many people. It doesn't have to be college. It could be trade school. It could be art school. It could be boot camp for coding, boot camp. Most plans offer what you call a set it and forget it investment option. So you don't have to diversify and pick the stock. Pick what you call target date funds. When you're younger, it's more aggressive, gives you time to grow. When you're older and closer to college, it gets more conservative, so you don't lose money. And it's easy to maintain, and it diversifies for you to minimize losses. You can still lose money. You can always still lose money, but it minimizes the chances that you lose money because it minimizes the up and down fluctuations. There is no age limit to when your funds could be withdrawn. How much can you put into this plan every year? Up to $15,000 per individual, or $30,000. So if you have a child, mom can put in $15,000, dad can put in $15,000. It's $30,000. However, listen to this. You're allowed to front load 5 years. What that means is if you have cash, you have money, you had a great year, you can put in up to 5 years worth of contributions. That's $75,000 today for your child. You don't get to put anything else in for the next 5 years, but guess what? You can put in $75,000 for your child. Your spouse could put in $75,000. That's $150,000. Hallelujah. Imagine how much money that's going to grow to. I know most people don't have that, but keep it in mind. The next time you hit a big, get a big bonus at work, you can do that. Here's one of the downsides, a few of them, for 529 plans. The funds can only be used for education. So unlike a custodial account, you have to use it for qualified education expenses like tuition and books. There's no self-directed investments, which means that you're limited to the choices that the state fund gives you. And sometimes the fees could be higher, so you got to be aware of fees. You got to check this thing out, 529 plans have a minimal impact on financial aid. For parent-owned plans, it ignores distributions. When you take cash out the plan, it doesn't count that as income. But a grandparent plan, while it's not counted as an asset for FAFSA, when you take money out, just like a Coverdell ESA, when you take money out the plan, up to 50% of that reduces the amount you qualify for financial aid. So please be very careful of that. I'm a financial advisor. I've advised many people on setting up 529 plan. It's very paper intensive. It's very cumbersome to set them up. Mostly slow, clunky state websites sometimes. And so, unfortunately, many of them don't even know what a 529 plan is. Many of them don't have the access. And when they do, it's hard to fund a 529 plan. It's hard to write a check every month for $500 or $800 into a plan. I created a plan where it's a mobile app. It's actually available on the App Store. We just did a full launch on March 21st. We just actually released it. It's for you. It's free. We don't charge you anything. Ladies and gentlemen, I gave you the best ways and the not so great ways. I started with savings accounts and I gave you the drawback. You don't get enough money. You don't get enough, and it's not protected from creditors. Investment accounts are better, but they're still taxable and they're still not protected from creditors. Custodial accounts are good to save for college, but they're limited in their usefulness, primarily because the kid owns the plan at 18 years old and can do whatever they want. We don't want that now. These kids spending all our money. Instead of going to school, they spend all our money on, buying, stuff that they don't want us to know about. Number 4, Coverdell ESAs, also called education IRAs. These plans are also good, but they're limited by how much you make, and they're also limited in terms of contributions you could put in. In my opinion, and I've been doing this a long time, the best way to fund college is through a 529 college education plan. Go to your state's plan. Google state 529 plan. Look at your state's plan. If you want a seamless, easier way, go to suchi.com, but please do something about it. If you have a child and you want your kid to go to college and you don't want to have to struggle to write that check, or you don't want your kid to take out student loans which hold them back, please set up one of these 5 plans. My preference is a 529 plan.